All right, ready to dive into some exciting financial statements?
Always.
Today, we're tackling the balance sheet, a document that can seem, I don't know, a little dry at first glance.
Maybe, but once you know how to read them, balance sheets can tell you a lot about a company. They're full of these little clues and stories if you know where to look.
Exactly. And to help us decipher those clues, we've got excerpts from a financial accounting textbook and some real world examples to really bring things to life. Our mission today is to make balance sheets, well, less of a mystery so you can confidently interpret them in the future.
Yeah, no more glaze over eyes when you see a balance sheet.
Exactly. So let's get right to it. Why should the average person, not just Wall Street analysts, care about balance sheets?
Well, understanding a company's financial position, which is exactly what a balance sheet shows you, can be super valuable for everyone from employees to, I don't know, just everyday consumers.
Oh, interesting. Give me an example. How would a balance sheet be useful to me if I wasn't, say, investing in the stock market?
Well, think about it. Let's say you're thinking about working for a company. Wouldn't you want to know if they're financially stable, if they've got a history of, responsible money management?
Yeah, that makes sense. I wouldn't want to join a company that's about to go belly up.
Exactly. Or let's say you're a supplier thinking about extending credit to a business, being able to assess their ability to actually pay you back. That's crucial.
Okay, I'm starting to see the value here. So, how do we get started? What's the first step in cracking this balance sheet code?
The foundation of it all is the accounting equation. It's really pretty simple. Assets equal liabilities plus equity.
Okay, that sounds straightforward enough, but there's got to be more to it than just a simple equation, right?
Of course. Let's think of it like buying a house. Your assets are everything the house owns, the structure, the land, the appliances, all that good stuff. Your liabilities are like your mortgage. It's what you still owe on the house. And then equity, well, that's your stake in the house. What's left after you subtract that mortgage from the total value?
Ah, okay. So if I sell the house and pay off the mortgage, whatever money I pocket, that's my equity.
Precisely. Now, swap the house for a company. The company's assets. That's stuff like cash on hand, the value of their inventory, any buildings they own, and even things like patents or a brand name.
Brand name as an asset. That's interesting. So it's not just physical stuff they own.
Right. Sometimes you'll even see goodwill on a balance sheet.
Oh, like warm, fuzzy feelings?
Not exactly. Let's say Microsoft buys a gaming company, and they pay more than the fair market value of all the gaming company's individual assets. That difference, that premium, is either recorded as goodwill.
Interesting. So it's like they're paying extra for the company's reputation or its loyal customer base.
Exactly. It's the value of things you can't really touch, but are still super important to a company's success.
Okay, so assets are everything a company owns. Got it. What about the other side of the equation, the liabilities?
Liabilities are everything the company owes to others. Unpaid bills, loans, even future obligations like salaries.
So it's not just about what they owe right this second, but also future debts.
Right. And we need to distinguish between short-term liabilities, stuff that's due within a year, and long-term liabilities, which stretch beyond a year, like, a big mortgage on their headquarters.
So if a company has a ton of short-term liabilities, like unpaid bills piling up, that's got to be a bad sign, right?
It depends. We need to look at their liquid assets, the stuff they can quickly turn into cash, to see if they can cover those short-term obligations.
So it's a balancing act. It's not just about how much they owe, but also how easily they can access funds to pay those debts.
Exactly. It's all about context. Now, the last piece of our puzzle is equity, the company's net worth. It's basically what's left over for the owners after all the liabilities are paid.
So it's like the equity in my house example. If the company sells everything and pays off all its debts, whatever's left is the equity for the owners.
Right, and this is where things get really interesting. Equity can grow through smart business decisions. Imagine they launch a killer product, profits go up. And some of that profit could be put right back into the company to fuel even more growth, increasing their equity.
Okay, so we've got assets, liabilities, and equity all linked by that accounting equation. But it can't just be a random list of these things, right? There's got to be some organization to a balance sheet.
Absolutely, there's a specific order to how these elements are presented, and that order gives us even more insights into the company.
Okay, spill the beans. What's this secret order?
Not a secret, just logic. Assets are usually listed in order of decreasing liquidity, so the stuff that's easiest to convert to cash, like, cash itself, comes first. Then we move down the list to things like inventory, and finally those big, hard-to-sell assets like property and equipment.
So it's like a hierarchy of how quickly they can turn those assets into cold, hard cash. What about liabilities? Are they organized in a special way too?
Yep, liabilities are typically listed in order of maturity, starting with those short-term obligations that are due soonest, and then moving down to the long-term ones. The order helps us quickly see if the company can meet its upcoming financial obligations.
So the order itself tells us something about the company's financial flexibility.
Exactly. And there's another layer to this puzzle, the way assets are valued. We can't just slap random numbers on a piece of equipment or a patent.
Okay, I'm intrigued. Tell me more about how they figure out what all this stuff is actually worth.
It all depends on the type of asset and, the accounting rules being followed. Some assets, like a new piece of machinery, are recorded at their historical cost, the original price paid.
But what happens when that machine gets old or outdated? It's not worth the same as it was brand new.
That's where depreciation comes in. It's a way to spread the cost of an asset over its useful life, basically acknowledging that stuff loses value over time.
So depreciation helps paint a more realistic picture of the asset's current value, right? We're not pretending a 10-year-old machine is worth the same as a new one.
Exactly. And things like investments, those can go up and down in value all the time, so they're usually reported at their market value, meaning their value gets adjusted based on their current trading price.
Makes sense. So if the stock market takes a nosedive, that'll impact the company's balance sheet. What about things like accounts receivable, the money customers owe the company? What happens if some customers don't pay up? Do they just erase those amounts from the balance sheet?
Not quite. They use something called net realizable value, which is basically what they realistically expect to collect, taking into account the possibility that some customers might not pay.
Okay, so if a company has a history of customers skipping out on their bills, that's a sign to look deeper into their financial health. It's like a clue that things might not be as rosy as they seem.
Exactly. It could point to problems with their credit policies or maybe issues with their customer base.
Wow, I'm seeing how every line item on a balance sheet has its own story to tell.
Right. And understanding the methods behind those numbers is key.
Speaking of methods, our textbook mentions something called GAAP. Can you give us the lowdown on that?
Sure, GAAP stands for Generally Accepted Accounting Principles. They're the set of rules and standards that publicly traded companies in the U.S. have to follow when they're putting together their financial statements.
So it's like a rule book for accountants to make sure everyone's playing fair and using the same playbook.
Yep, GAAP helps to make financial information more transparent and comparable. It makes it easier for investors and, well, anyone to understand and compare different companies.
Right, because it would be chaos if every company just made up their own accounting rules. Investors wouldn't know what to believe.
Exactly. GAAP helps to ensure that we could trust those financial statements. It provides a level playing field.
Got it. And one more thing I'm curious about, the textbook also mentions accrual accounting. What's that all about?
Accrual accounting focuses on when revenue is earned and expenses are incurred, even if the cash hasn't actually changed hands yet.
So it's not just about tracking when money comes in and out of the bank account.
Right. It's about matching revenues and expenses to the period they actually belong in, giving us a more accurate picture of a company's profitability.
Can you give me an example to help me wrap my head around this?
Sure. Imagine a magazine publisher. They sell a year-long subscription and the customer pays upfront for the whole year. But with accrual accounting, they wouldn't record all that revenue right away. Instead, they'd recognize a portion of it each month as the customer receives each issue of the magazine.
Ah, that makes sense, because they're providing the service over the course of the year, not all at once.
Exactly. It's about reflecting the economic reality of the situation, not just the cash flow.
Okay, so accrual accounting is about matching those revenues and expenses to the right time period, even if the cash flow doesn't line up perfectly.
You got it. And it's one of the key principles behind GAAP, helping to make financial statements more accurate and meaningful.
Wow, we've covered a lot of ground already. It seems like every element on a balance sheet has hidden depths and nuances, but how does all this theory actually play out in the real world? Can we walk through an example to see these principles in action?
Absolutely. Let's put on our detective hats and take a look at a simplified balance sheet to see what we can uncover.
All right, so we're ready to put our balance sheet knowledge to the test. Let's pretend we're financial detectives, investigating a company called, how about Tech Innovations, Inc.?
Sounds good to me.
Okay, I've got their balance sheet right here. It's a simplified version, of course. First impression. It's actually a lot less intimidating than those huge reports you see in the news.
Yeah, we've stripped away some of the, I don't know, the jargon and complexity so we can focus on the core stuff. But even this simplified version can tell us a lot. What jumps out at you when you first look at it?
Well, I'm noticing they've got a pretty big chunk of cash and cash equivalents. That's a good thing, right? It means they've got plenty of, liquid assets to cover their short-term debts.
You got it. Having a healthy cash position gives companies flexibility. They can invest in new opportunities, deal with unexpected problems, even pay dividends to their shareholders. It's good to have cash on hand.
Makes sense. But I'm also seeing a pretty big number under accounts receivable. That's money that customers owe them, right? What if those customers are slow payers?
That's a sharp observation. While a decent amount of accounts receivable means the company's making sales, a huge amount that's overdue could be a warning sign.
So it's not just the total amount, but how long it's been outstanding.
Exactly. You want to see that they're collecting payments on time, that their customers have a good track record. Otherwise, it could lead to cash flow problems down the road.
Okay, got it. Moving down the list, we've got inventory. I assume that's all the products they have, sitting in their warehouse waiting to be sold.
That's it. Inventory is a big asset, but it can also be a challenge. What if the products aren't selling well? Or what if they become obsolete because, something newer and better comes along?
Right, they can't just sit on a mountain of unsold stuff forever. What happens to their balance sheet if those products start collecting dust?
Well, they might have to reduce the value of that inventory, what's called a write-down, and that can hurt their profitability, ultimately reducing their equity.
So, managing inventory is like a balancing act. They need enough to meet demand, but not so much that it becomes a liability.
Exactly. It's a tricky thing to get right. Now, let's look at the big ticket items: property, plant, and equipment. This is all the long-term tangible assets the company uses, things like buildings, machinery, vehicles.
The stuff that keeps the lights on, right? But remember, we talked about how these things are often recorded at their historical cost minus depreciation. So the number on the balance sheet might not reflect what they're actually worth today, right?
That's a key point. Historical cost gives us a starting point, but we need to factor in depreciation. A company with old equipment might look like it has more valuable assets than it really does.
So we have to dig deeper, consider the age and condition of those assets, not just their book value.
Right. And here's another interesting thing about this category. Land, which is included here, it usually isn't depreciated.
Why not? Does land just hold its value forever?
Well, in accounting, land's considered to have an indefinite useful life. It doesn't wear out like a machine does. It's assumed to either hold its value or even go up in value over time.
Makes sense. Okay, I think we've covered assets pretty thoroughly. Let's switch gears and look at the other side of the balance sheet, those liabilities. What are we looking for here?
Liabilities tell us what the company owes to others. The first thing we often see is accounts payable, which is basically the money they owe to their suppliers for goods and services they've received.
So if accounts receivable is the money customers owe to the company, then accounts payable is like their own outstanding bills, right?
Exactly. It's like they're running tab with their vendors.
So just like with accounts receivable, the key is to see how quickly they're paying their bills. Are they keeping their suppliers happy?
Right. A long payment cycle could be a red flag. It might mean they're having cash flow problems, or maybe they're not managing their relationships with suppliers very well.
Okay, so efficient bill paying is a good sign. What about notes payable? Is that another type of debt?
Yep, that's right. Notes payable are formal debt obligations, often with a written promissory note. Think bank loans, lines of credit, that kind of thing.
So to really understand this, we'd need more details, like the interest rates, when those loans are due, if there are any special conditions attached to them.
Exactly. Those details are usually found in the footnotes to the financial statements. We need to look at the company's total debt and see if they can handle it.
All right, what other liabilities should we be on the lookout for?
One important one is accrued expenses. Remember how we talked about accrual accounting? Well, this is where we see it in action. Accrued expenses are expenses that have been incurred but hasn't been paid yet.
Can you give me an example so I can visualize this?
Sure, let's say our fictional tech innovations has a team of software engineers working on their next app. They've worked hard, earned their salaries, but payday isn't until next week. Those unpaid wages would be recorded as an accrued expense.
So even though the money hasn't left the company's account yet, they still have to recognize the expense because the work has already been done.
That's right. It's about matching the expense with the period it belongs to, regardless of when the cash actually changes hands.
Okay, so we've tackled assets and liabilities. Now it's time for the final piece of the puzzle. Equity. That's the company's net worth, right?
Exactly. It represents the owner's stake in the company. In our simplified example, we see two main things under equity: common stock and retained earnings.
Okay, let's break it down. What exactly is common stock?
Common stock represents the ownership shares that the company has issued to investors. It's the most basic form of ownership and usually comes with voting rights, so shareholders get to have a say in how the company is run.
So if I buy a share of common stock in Tech Innovations, Inc., I'm officially a part owner, and I get to vote on company decisions.
You got it. You're a part owner, and you get a share of the company's profits, if there are any.
And what about retained earnings? Is that like the company's savings account?
It's kind of like that. Retained earnings are the profits the company has earned over time that they've chosen to keep within the business instead of paying them out to shareholders as dividends.
So it shows us how profitable they are and whether they're committed to reinvesting in the business for future growth.
Exactly. A healthy amount of retained earnings is usually a good sign. It means they're generating profits and using them wisely to grow the business.
Wow, we've really dug onto this balance sheet. I'm starting to feel like I can actually read between the lines now.
That's great. But remember, a balance sheet is just a snapshot in time. To really understand a company, we need to see how these numbers change over time, compare them to other companies in the same industry, and look at their historical performance.
So it's about spotting trends, not just focusing on a single point in time. We need the whole story, not just a single chapter.
Exactly. And the balance sheet is just one piece of the financial puzzle. We need to look at the income statement and the statement of cash flows, too, to get the full picture of a company's financial health.
Well, I'm feeling much more confident about understanding balance sheets now. They used to seem so mysterious, but now they're like fascinating puzzles to solve.
I love that analogy. And the more you practice analyzing them, the better you'll get at spotting those clues and understanding what they mean.
Okay, so we've learned the basics, but let's get practical. If I'm looking at a balance sheet for the first time, what are some red flags, some things that should make me dig a little deeper? Yeah, give me some examples. What are some things that should make me go, maybe I need to take a closer look?
Okay, so on the asset side, one thing to watch out for is a lot of overdue accounts receivable. Like, if a bunch of those receivables are way past due, it could mean the company's having trouble collecting payments.
So even if the total number for accounts receivable looks good, we got to check how old those receivables are.
Exactly. We want to know if they're actually getting paid, not just if people owe them money. A bunch of old, unpaid bills, that could be a sign of trouble.
Okay, aging receivables, that's one to watch. What about inventory? Any red flags there?
Oh, yeah, definitely. If a company has way too much inventory, that's not a good sign. It might mean their products aren't selling as well as they thought, or maybe they're just not managing their inventory very well.
So too much inventory could mean weak sales, products become outdated, maybe even bad planning.
Right. And remember, if those products sit around too long, they might have to write down the value, which would hurt their assets and their equity. It's like money just sitting there not doing anything.
Okay, so we got a couple warning signs on the asset side. What about liabilities? What should we be wary of there?
One of the biggest red flags is a high debt-to-equity ratio. This compares how much debt a company has to its shareholder equity. If they have a lot more debt than equity, well, that means they're relying heavily on borrowed money.
And that can be risky, right? They've got to make those interest payments, and it might limit their ability to, invest in growth opportunities.
Exactly. It makes them more vulnerable if the economy takes a downturn or if something unexpected happens.
Okay, so a high debt to equity ratio, not a good sign. But let's talk about some positive things. What are some green lights on a balance sheet that tell us a company's in good shape?
Well, one of the most obvious is a strong cash position. Like we said before, cash is king. A good amount of cash on hand gives them flexibility.
Yeah, it's like a financial safety net. They can use it for unexpected expenses, investments, or even to pay dividends to their shareholders.
Right. Another good sign is a healthy level of retained earnings. If they're consistently making profits and putting those profits back into the business, it means they're focused on growth.
So retained earnings show us they're profitable and thinking long term. They're not just spending all their profits right away.
Exactly. And while a high debt-to-equity ratio is bad, a low one is generally good. It means they're using a good mix of debt and equity to finance their operations.
But there's no magic number, right? It depends on the industry and the specific company.
That's right. Context is everything. What might be a good ratio for one company might be terrible for another.
Okay, so we got to look at the bigger picture, not just focus on one number in isolation. Any other big takeaways to keep in mind when we're looking at balance sheets?
One of the most important things is to look at the trends. Is the company getting better or worse over time? Are those key ratios moving in the right direction?
So it's not just about a single point in time, but the overall direction they're headed.
Right. It's about the story those numbers are telling. And remember, the balance sheet is just one part of that story. We need the income statement and a statement of cash flows to get the complete picture.
Well, I gotta say, I feel a lot more confident about reading balance sheets now. They used to seem kind of scary, but now I see them as like puzzles to figure out.
I love that. And the more you practice, the better you'll get at it. It's like a muscle you can train.
I encourage everyone listening to grab a balance sheet of a company they're interested in and see what they can learn. It might be more interesting than you think.
And remember, this is just the beginning. There's so much more to explore in the world of finance, but you've got a solid foundation to build on.
Thanks for joining us on this deep dive into the world of balance sheets. Until next time, keep those curious minds engaged and happy analyzing.